Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Hello everyone, my name is Zhong and welcome to Through the Noise podcast. Plenty to discuss about this week, from a new properties measures in China and country gardens avoidance of default to OPEC Plus cut extensions and the various central banks officials' comments and the economic data. To do that, I've invited Abhilash Narayan, our senior investment strategist, to join us. Welcome Abhilash. Like I said, plenty to talk about, so let's dive right in. Recent economic data has been quite a mixed bag. What is your read of the recent US Europe data and what it means for equities and bond investors?
Thanks, Zhong. Well, clearly, the tussle between higher for longer rates eventually leading to a hard landing scenario and a cooling inflation which may help us avoid a recession. Both those narratives continue to gather steam. Now, let's start with US. We saw the pace of job creation continue to slow down with previous 2 months payrolls being revised lower. However, the US economy is still generating almost twice the number of jobs needed to keep the market from overheating. We also saw a rise in labor force participation, which meant that jobless rate climbed to 3.8%. But we think that further gains in participation are likely to be limited. On the other hand, US services sector confidence, according to ISM PMI, beat expectations, rising to 54.5. Now, the rival S&P Services PMI, which focuses purely on private sector companies, was actually revised lower to 50.5, which borders between expansion and contraction. Now, judging by equity and bond markets' negative reaction to the strong ISM Services PMI data, it seems that investors are treating good news as bad news. US rate expectations were revised higher, and government bond yields approached their 16-year highs. S&P 500 also broke the 50-day moving average. Shifting the focus to euro area, we saw European growth slow down, and we saw an 11% year-on-year plunge in German factory orders. Yet, euro area's core inflation remains much higher than US. An elevated inflation and tight job market explains the continued hawkishness of ECB policymakers despite the growth downturn. Now, the latest data has raised the risk of hard landing, especially if oil prices continue to rise, which could lead to higher rates and also higher US dollar. So we would use any rise in developed market government bond yields to average in, as bonds offer significant upside and limited downside in the event of a sharp slowdown in global growth.
You spoke about the using any rise in DM government bond yields to average in. How about DM corporate bonds? What are the implications of the recent rise in US government bond yields on them?
Well, if you look at the nominal yield of developed market investment grade corporate bonds, that has increased to nearly 5.5%. But if we dive under the hood, the yield premium or credit spread has remained relatively resilient. And that means that almost entire increase in yields that we have seen has been driven by the increase in government bond yield component. Now, although we expect government bond yields to edge lower in the next 12 months, we are not convinced that yield premiums will probably stick around the current levels. And that's because of two reasons. Firstly, yield premiums are lower than their long term averages, which means valuations are high, right? And we expect them to mean revert. Secondly, our view of US economic recession in 2024 suggests that yield premiums may be insufficient when pricing the risk of rising defaults or corporate fundamental deterioration. So we think that investment returns earned from the decline in government bond yields is likely to be offset by widening of developed market investment grade corporate bond yield premium, and hence we are more inclined to add exposure to developed market government bonds, and use the recent outperformance of corporate bonds to as an opportunity to reduce exposure to them and switch into the government bond space.
Okay, let's move away from developed markets. We also saw a number of policies announcements from China. Are these recent property sectors and FX measures enough to revive the equity markets and most importantly, the CNY?
Well, that's a great question. So maybe let's look at the impact on bonds, equities, and FX one by one. So let's start with bonds. Now, we think that the recently announced policy measures for the property sector are a positive, but they are still insufficient for a broader market revival. Now, Country Garden's avoidance of default helped Chinese and Hong Kong real estate sector bonds edge modestly higher, and we saw Asian high yield bond premiums decline by around 40 basis points. However, the sector continues to face significant challenges, including lower sales, declining home prices, and high funding costs. Hence, we continue to see the risk reward for Asian high yield bonds as less compelling when compared to investment grade bonds, which are our preference within the Asian dollar bond market. If we shift our focus to FX, dollar CNY continued to rise despite the measures we saw in property sector in equity markets, and also despite the reduction in FX triple R rate or reserve requirement ratio. Now, PBOC has been unwavering in its support for CNY, and it has been setting stronger fix for 54 consecutive days. However, weak investor sentiment and the wide interest rate differentials relative to US means that we are going to probably continue to see an upward pressure on dollar CNY in the near term. Last but not the least, if we shift focus to equities, the Hang Seng Index managed to break above the key resistance of 18,800 earlier this week before consolidating. Now, we think that the positioning led rebound in Chinese equities is likely over the next 2 to 4 weeks. However, a more sustained rally needs to see evidence that the targeted stimulus measures that have been announced are resulting in solid rebound in domestic demand.
Okay, can't let you go without talking about the latest decision by Saudi Arabia and Russia to extend output cuts. What is the latest outlook on oil?
Thanks, Zhong. Well, the extension of the production cuts was somewhat in line with expectations. What surprised the market was the duration of extension till December 2023. Now, both Brent and WTI crude oil prices have jumped higher on the news and have broken several key technical levels. Now, if you look at the extension of production cuts, we think that OPEC will hold off from cutting production further in future. Now, that's because of a few reasons. Firstly, the current oil price offers a good buffer over the break even prices and helps them meet the objective of price stability. And secondly, if we analyze previous instances of OPEC production cuts, each cycle had 2 to 3 collective cuts happening in past. Now, in this cycle, OPEC Plus is on its third cut. And we think that oil markets are now likely in deficit after the most recent extension of production cuts. So if you look at WTI crude oil from a positioning perspective, that has risen from its lows in July and is just below its cycle high. From a technical perspective, both RSI or relative strength index and stochastic oscillator indicators are signaling that WTI crude oil may be overbought. Additionally, looking at Bollinger Band, that is also signaling that the move in WTI prices is overextended. So when we put all of this together, we think that a consolidation is imminent and we would fade any rally at the next resistance of 88, which is a level that WTI has failed to break in its 2 previous attempts.
Thank you, Abhilash. Appreciate the insightful sharing. To conclude, we would use any rise in DM government bond yields to average in. 2, we have a preference for Asian IG over high yield. 3, dollar CNY is likely to see further upwards pressure. And 4th, a positioning-led rebound in Chinese equity is likely over the next 2 to 4 weeks. And lastly, we'll fade the oil rally at the next resistance of $88 per barrel. We've come to the end of this week's podcast. Plenty to look forward to next week as well, in particular the ECB rates decision. But before that, have a wonderful weekend. Cheers.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.